Hello and welcome to this ninth lesson in financial accounting. So today's lesson, what we're covering is inventory. So let me give a brief overview of what inventory is, because you're going to come across this word more often than not as you progress with your accounting studies, which is financial accounting as well as financial reporting and advanced financial reporting. So, for example, I'll give an example of ShopRite. So, ShopRite trades in different products, right? They sell beverages, they sell foodstuffs, and other items. So, let me give an example of, say, maybe mineral water. So, when you go to ShopRite, you want to buy mineral water. From ShopRite's perspective, that mineral water is what's called inventory. So I'll reduce the example to just maybe a corner store, one of the corner stores which is owned by Randi's, right? So you go to the store, you want to buy bread. That bread that you're buying from the store's owner, that's what's called inventory. So in simple terms, inventory is just stock of goods that is supposed to be sold or that is hoped to be sold to the customer. And that's the simple definition of inventory. Okay, so let's carry on. So the other thing that you need to understand with respect to inventory is what we call the cost of goods sold. So when you're preparing the statement of profit or loss, there's a certain format that you follow. We're going to cover that in the follow-up lessons. So there's the sales, then you deduct the cost of sales. So for you to get the gross profit, after you get the gross profit, then you deduct the operating costs, and then you get the profit before interest and tax. Then you deduct the interest expense, then you have the profit before tax, and then when you deduct the tax, you're going to have the net profit. So here our main focus is the cost of goods sold. So it's cost of sales, in other words, right? So the first thing that you need to understand is what's called closing inventory. So closing inventory is the unsold goods in stock at the end of the accounting period. All right, so you have a store, you've got a shop, you sell bread. Okay, let me just say you've got a bakery, you sell bread. And then at the end of the period, you've got inventory of, say, 5,000, right? So you've got stock of bread amounting to 5,000. So that value of 5,000 at the end of the period on 31st December 20 whatever, I think maybe 2023, right? That 5,000 worth of goods is what's called closing inventory. If this same 5,000 is pushed over to the next period, which is the 1st of January 2024, right? That closing inventory becomes opening inventory. So basically, opening inventory is the unsold goods that are carried forward to the next period from the previous accounting period. All right, that's what closing and opening inventory are. So closing inventory is the inventory that you have at the end of the period. Then that same inventory, when you push it, you carry it forward to the next period, it becomes the opening inventory. Then you've got the cost of goods sold. How do we calculate the cost of goods sold? So the first thing that we have here is the open inventory. I've already explained what the opening inventory is. So you've got 5,000 worth of goods at the end of the period. Then you push it forward to the next period. That's the opening inventory. So you've got the opening inventory. So inventory, this is the closing inventory from the previous period. Then purchases. What are purchases? So basically what purchases are, this is where, say, I'll give the typical example of a grocery store. You've got 5 cases of mojo as opening inventory, and then during the course of the period, you say, okay, I think I need 10 more cases. You go and buy these 10 more cases. All right. That is what we call purchases. So what purchases are, this is just where you buy inventory during the course of the period. But this can be replaced with cost of production if you're the one who's manufacturing. So from your perspective as a distributor, as a retail trader, when you purchase items or inventory from TradeKings, that's what's called the purchases. But from TradeKings perspective, they're the ones who are producing the inventory. So what they add as purchases to some extent is the cost of production. We're going to cover this when we look at the manufacturing accounts. Then you've got closing inventory. So as I've already explained, closing inventory, this is just the inventory that you have. So if you began the period with 5 cases of Mojo, then you purchased, say, 10 cases of Mojo, then at the end of the period, you've got 2 cases of Mojo. That's the closing inventory. So now, how do you calculate the cost of sales? Alright, so the cost of sales, opening inventory plus the purchases less the closing inventory, and now you're going to have what's called the cost of sales. So you need to understand this, and if and when I send the format for preparing the statement of profit or loss, you're going to have a further understanding of what the cost of goods is. Right, so now there's another concept that you need to understand, which is the carriage inwards and the carriage outwards. Right, so carriage inwards, what is carriage inwards? So carriage inwards, so don't really worry about this word carriage. So carriage just means transportation. So carriage inwards simply means when the company pays for delivery of inventory to its premises. So you buy 5,000 worth of inventory, right? And then you say, okay, I think I need to pay for transport, so that this inventory is delivered to my premises. Maybe if you pay 500 kwacha, right? This 500 kwacha, which is specifically for the transportation of inventory to your premises, is what's called carriage inwards, right? And then there's also what's called carriage outwards. So carriage outwards is just the opposite of carriage inwards. So carriage outwards is from the business perspective, where the business pays for the transportation of goods to the premises of the customer, right? So the customer buys. So for the most part, TradeKings, what TradeKings does, when you buy on credit from them, they'll transport these goods to you. Yeah, so you buy 5 cases of Mojo, TradeKings is going to transport these goods to your premises. So from TradeKings perspective, that cost of transporting goods to your premises is what's called carriage outwards. Then goods written down or written off. So goods written off or written down. So sometimes, for one reason or the other, inventory can lose value. So maybe you've got a case of Mojo, I don't know how much it is, but I'll just say maybe 100 kwacha. So this is the cost, or this is the value of the Mojo in its good state. So due to one reason or the other, maybe say these drinks are going to be expired maybe the next 2 months, then the value is going to go down. Maybe you sell 1 case at 50 kwacha, right? Then it means these goods have been what? They've been written down. Maybe to some extent where you have goods worth 100 kwacha, right? And then they are expired. In that moment, they're expired. So the value becomes 0. So what do? You have to write them off because they don't have any value. So that's what we call goods written off and goods written down. Then let's look at IS2. So IS2, this is a standard which looks at inventory, right? So what are inventories? So what you need to know, inventories are assets. But what type of assets? Inventories are current Inventories are current assets. So these are assets, which are going to be realized within 12 months. So they're going to be sold off within 12 months. They don't really exceed more than 12 months. So the definition for inventory, these are assets which are held for sale in an ordinary course of business, right? They're held for sale in an ordinary course of business, which is within the 12 months that we've already outlined here. Then two, inventory are assets which are in the process of production for such a sale. So this is what we call, these are goods which are in the process of production, right? Work in progress. So these are goods that are in the process of production, right? You're producing goods, they're in the process of being completed. Maybe they've passed through one process, then they're going to the other process. So this is also called inventory. Then in the form of raw materials and products used in the production process, right? So each item that's being produced has got its own raw materials, So those raw materials, if they're going to be used in the process of production, they're also defined as inventory. So inventories are assets which are held for sale in the ordinary course of business. So these are finished goods. So assets that are in the process of production for such a sale, work in progress, then in the form of raw materials and products used in the production process. So these are the raw materials that are used in the production process. So now, the other thing that you need to understand is, how do we value inventory, right? Inventory is valued at net realizable value, or in short, the NRV. So this is how we measure inventory, rather how we value inventory. So inventory is valued at net realizable value. So what is the net realizable value? So then the net realizable value is the estimated selling price. So the selling price, how much are we going to sell that inventory? Then you deduct the estimated cost of completion. All right, completion simply means the estimated cost of completing the sale, and then the estimated cost necessary to make the sale, right? So the selling price minus the estimated cost of completion, and then the estimated cost necessary to make the sale, right? So the selling price, then the less the cost of completion, or rather of completing the sale, and then the estimated cost necessary to make the sale. So now, what are some of the examples of inventory? Some of the examples of inventory include goods held for resale. So you buy goods, then you want to resell. So you buy maybe, say, 10 cases of mineral water, then you want to resell. That's inventory. Then finished goods produced. So a company produces its own goods, and then it wants to sell those goods. That's what we call an example of inventory. Okay. So now, how do we measure inventory? So we value inventory at net realizable value, but how do we value it? So inventory should be measured. What did I say? So we value inventory at net realizable value, and then measuring it. How do we measure it? So inventory should be measured at the lower of cost and net realizable value. So let's say the cost here is 5,000. Right? I like 5,000. This is the cost. And then the NRV is, say, 4,500. So when you deduct the cost of completion and the cost of making the sale, it's going to arrive at 4,500. So now we need to measure this inventory at the lower of. So what the lower of means, you need to compare these two, and then you pick out the lowest. So the lowest amount between 5,000 and 4,500 is 4,500. So it means the inventory is going to be measured at what? 4,500. And this is the value that we're going to put in the statement of financial position. Alright, so now, how do we calculate the cost of inventory? So the cost of inventory is calculated by, one, you get the purchase cost. How much are we buying the inventory from the supplier? So if it's 1,000, then that's the purchase cost or purchase price. So it can either be the purchase cost or purchase price. And then you add the import duties as well as other taxes. So if you are importing from outside the country, so all the import duties that are applicable, you add them. But other taxes can include VAT. So maybe if you're adding maybe a VAT of, say, if it's VAT inclusive, you're adding VAT of, say, maybe 100. That's included. Okay, 100 is just too much. I think, let me say just 10. So a VAT of 10, you add that. And then transport and handling and other costs directly attributed to the acquisition of the finished goods and services and materials, right? So any other costs related to handling and transportation and every other cost that's related to making sure that the goods are in the sellable state, right? You add that. So if all those costs, say they are maybe 500 for argument's sake, and then any trade discounts. So if you're given any trade discounts or rebates, so rebates, this is where, say, you are a frequent customer to a particular supplier, and then this supplier gives you a certain monetary value or monetary amount to appreciate that you've reached a certain level of purchase, a certain quantity of purchase. So you've purchased up to a certain quantity, then to appreciate you, this particular supplier says, okay, I'm going to give you this amount of money. That's what we call a rebate. So all those rebates, you add them. So maybe the rebates and discounts are 100, then you deduct that. Yeah, so you've got 100, so you've got 1,000. So you've got 1,000 plus 10, right? So you've got 1,000 plus 10 plus 500, then you deduct the 100. It's going to give us, so it's 1,000 plus 10 plus 500, and then you deduct the 100. So it gives us 1,410. 1,410. That is the cost of the goods. Alright, so with that done, I think the lesson has come to an end. So now let me just try to summarize it a bit. So my primary focus is on the cost of sales, but you're going to see this cost of sales as we look at the statement of profit or loss, both for the sole trader, the company, as well as the partnership. So yeah, so we've got the cost of goods sold. This is just the cost of sales, which includes the opening inventory, the purchases. So the other thing that you need to know, the cost of goods sold also includes the carriage inwards. The cost that is spent on the carriage inwards is also included in the cost of sales, and then you deduct the purchases returns. Yes, every amount that you pay to the the amount of goods that you take back to the supplier, the purchases returns or returns outwards, is also included in the cost of sales. So we've got the opening inventory plus the purchases, right, plus the carriage inwards minus the sales or purchases return rather, and then minus the closing inventory. Then you're going to have the cost of sales. Otherwise, our lesson has come to an end. Thank you.